A lot of people are looking for kind of the middle ground. They want the safety of their principal. They want to know they're not going to lose it. They also want to know they've got this guaranteed contractual lifetime income. And a lot of times that's a perfect fit for a fixed indexed annuity. And I know in your book, you call that the middle ground between an income annuity and a variable annuity. So talk to us a little bit about the fixed indexed annuity, what it is, kind of how it works, kind of on a maybe on a high level scale.
Right. So fixed index annuities, they are that middle ground. And I usually, because of focus on retirement income, think about annuities for lifetime income. And you get that generally with a fixed index annuity by having a living benefit attached to it. But also, just with the tax code in the US, annuities do get tax advantages. And so sometimes people also talk about fixed index annuities, not necessarily for lifetime income, but because they provide an attractive after-tax return compared to other potential bond investments that they may be looking at. But the fixed index annuity, it's the way it's structured, it provides principal protection. People can't experience losses on them, and it's because the insurance companies just buying enough bonds to make sure that when those bonds provide their interest at the end of the term, you've got the principal fully protected. Because interest rates are greater than zero, it doesn't take all the money to provide that principal protection.
Right.
So then with a portion of that leftover, they're going to buy exposure to a market index such as the S&P 500, which then gives you can't experience a loss even if it's linked to the S&P 500, even if the market's down 40%. The bonds protected your principal, and then you wouldn't get any upside from that. But if the market's up, you are going to share in a portion of that upside through the financial derivatives that the insurance company is purchasing with some of those leftover funds. And so therefore you get principal protection. You can't experience a loss. You're not going to get the full gain of the market. You shouldn't expect that, but you will get a portion of any market gains as well. And then when you consider the tax advantages, that can be an attractive alternative to other, not it's not a replacement for stocks, even if it's linked to a stock index, but it can be a nice replacement for some of the bonds. It can outperform other bond options, and that's where a lot of the interest lies. And then if you overlay a lifetime income benefit on top of that, then we're entering that world of having that risk pooling insurance lifetime income protection as well.